We're going to take a quick look today at the crude oil market. This market's been on fire, but anyone who's looking for some sort of correction in order to buy this very strong uptrend, a great place to start would be to take a look at the Fibonacci retracements. Now, I know not everyone is a fan of Fibonacci, but usually to me it means that they haven't learned how to use it right, because once someone learns how to use Fibonacci correctly, without exception, they usually become fans, because the subjective nature of Fibonacci certainly can try one's patience, but once you understand how to go ahead and draw these lines, the support and resistance they yield is really, really accurate. So let's talk about where the Fibonacci lines would be drawn in this case. We're talking about a low, and this is the low I'm talking about right here. This low right here is going to be the level to watch for any kind of for any kind of reversal to the upside. And then on to the top side, we're going to be looking at this high. Now these are the two, these are the two high, this is the high and the low, the two prices that are going to make up what we will call the last major move. Now that's really the most ideal way to look for Fibonacci. You have to find that last major move, which basically means what was the last major rally or last major sell-off. And you can see here, clearly this would have been the last major rally. So from this low to this high. Now, Fibonacci also presupposes that the market will reverse, which means that this high there cannot be a new high to take this one out, otherwise we'll be drawing a brand new Fibonacci set. So this high is actually at 82.40. Now, when you're doing this on your own, try to get as exact as you can get. Just for getting this done, expediency, I'm going to go ahead and just get it as close as I can get. But again, on your own, do this as perfectly as you can. So I'm off by 1 cent, okay? So you can see here, last major move was a rally. And when you draw your Fibonacci, I'm drawing it from the low to the high. I'm drawing it with the direction of the market, from this low to this high. So again, as long as this high stays in place, in other words, that we feel the rally is completed, and we won't know until the next candle or the next day or whatever the time frame is, but we move forward one candle, and you can see the market did indeed move down lower the next day. The next day it went down lower still. Now, what are these percentages here? This is 25% of this larger move. 25% of this move would be this support level right here. 38%, 50%. This 50% basically is the halfway mark between this last major rally. So these are all going to be support levels as the crude oil market may or may not correct. We'll see. But the first opportunity a trader would have to buy this market would have been this bounce off 78.97, or rounding up to 79. The psychological decade number would have been fine too. But this would have been the first chance a trader who wants to get long in crude oil would have to enter on this correction, and that's ideally what we want to do in uptrends. So again, quick little lesson on Fibonacci, how to draw it. These are the levels that I personally use, and again, these are all going to be support levels or corrections within this last major move that was a rally.